Picture this. You've got a $2 billion portfolio in SCHD, an ETF known for its solid dividend gains. With a 3.6% annual dividend yield, that's $72,000 a year, or $6,000 a month in your pocket, without selling a single share. For many, that's more than enough to cover rent, groceries, and maybe even a vacation or two. As the concept of living off dividends gains traction, SCHD has quietly built a dedicated fan base. On the flip side, this VOO, the classic S&P 500 ETF, has always been the to-go for long-term growth. So it got me thinking, how do I decide between SCHD and VOO? In this video, we'll explore SCHD, its pros and cons compared to VOO, and some practical investment strategies. By the end, you'll have a clear understanding of which ETF could better align with your financial goals. And if you are new to investing, be sure to check out my video on index fund investing basics to get started. Without further ado, let's first take a closer look at SCHD. SCHD, short for Schwab US Dividend Equity ETF, tracks the Dow Jones US Dividend 100 Index. It's earned a strong reputation by focusing on quality companies with a reliable history of paying dividends. At its core, SCHD uses a strict set of criteria to filter its holdings. Companies must demonstrate consistent dividend payouts, show strong financials, and deliver competitive performance over time. You can find more details about SCHD through the link below in the description. These requirements help SCHD build a portfolio that prioritizes quality and sustainability of dividends while maintaining steady growth in share price, making it one of the top 30 ETFs by assets, with $66 billion in assets under management as of end of 2024. If you pop the hood on SCHD, you'll notice it's heavily weighted towards value stocks. These mature, often undervalued companies are great at generating reliable cash flow. Unlike growth stocks, which focus on reinvesting profits for expansion, value stocks return those profits to shareholders in the form of dividends. Take Chevron, for example, a top holding in SCHD. It's been increasing its dividend payouts every single year for decades while steadily growing its market value. When you combine companies like this in one portfolio, you got SCHD. There are several popular reasons why SCHD gets so much love from investors. Some investors consider its dividend as actual free money beyond price appreciation. Based on its history, SCHD has been distributing dividends since its inception and has been increasing its dividend growth every single year. As of today, for every SCHD share you hold, you will get almost $1 as dividends. This consistent growth makes SCHD attractive to investors who value increasing additional profit. But it doesn't just stop there. People like SCHD also because dividends can be reinvested to purchase more shares, which in return generate even more dividends over time, creating what's often referred to as the snowball effect. Some investors believe this compounding effect can lead to significantly higher returns compared to solely relying on price appreciation. And when you combine SCHD's dividend payouts with its annual price appreciation, the return looks so appealing, no wonder it's considered a standout choice by so many. Now at this point, SCHD might sound like an investor's dream, and you might be tempted to hit that buy button immediately. But before you do that, let's clear up some common misconceptions that could catch you off guard. Dividends are not free money, although many investors mistakenly treat them as bonus income on top of price appreciation. In reality, stock prices are adjusted to reflect dividend payouts. When a dividend is distributed, the share price typically drops by the same amount after going ex-dividend. Here's a simplified example. Imagine ETF A starts the year at $100 per share and rises to $110 by year end, giving you a 10% return from price appreciation. Now consider ETF B, which performs identically but distributes a $3 per share dividend at the end of the year. Once the dividend is paid, ETF B's share price drops from $110 to $107. Your total return is still the same, 7% from price appreciation and 3% from dividends, equaling 10% overall. Dividends in this case are essentially part of your profit deducted from price appreciation. You are not getting extra money, just receiving it in a different way. SCHD's consistent record of increasing its dividend payouts every year for over 13 years is impressive. However, some investors misinterpret this as unlimited potential for outsized returns. For instance, you might hear someone ask, what if one day my $1,000 investment in SCHD pays me $1,000 in dividends the same year? Unfortunately, that's unlikely. Why? Because SCHD has a rather stable dividend yield history. Dividend yield is the amount a company pays in dividend relative to its stock price. Historically, SCHD's dividend yield has hovered between 3 to 4%, meaning that no matter how much you invest, the dividend you receive each year will typically equal only 3 to 4% of the value of your holdings. Let's break it down. In 2013, you could trade SCHD around $10 per share at some point, meaning a $1,000 investment could buy 100 shares. With a 30 cents dividend per share, you'd have earned $30 in dividends or 3% yield. Fast forward to 2023, where the payout per share has risen to 88 cents, SCHD's share price has also risen to around $25. The same $1,000 will now buy 40 shares, earning $35.20 in dividends, still within the 3 to 4% yield range. The point? Even if dividend payouts rise, the amount of dividends you receive is tied to your portfolio's value and the yield rate, not just the payout growth. SCHD's snowball effect, dividends reinvested to generate more dividends, sounds great. But if we only focus on the dividend compounding, we're missing the big picture, total return, which combines both price appreciation and dividends. By the way, many people may not know, VOO actually offers a dividend yield of 1 to 2%. It's solid but just overshadowed by SCHD's greater value. But according to historic data, VOO frequently beats SCHD in total return. Let's look at a backtest. Starting with $10,000 in January 2015, reinvesting dividends each year, VOO outperformed SCHD in most years. However, the exceptions, like from April 2022 to April 2023, when SCHD did a better job than VOO amid high inflation and economic uncertainty. So am I saying SCHD isn't a good investment option? Absolutely not. All I want to emphasize is this: don't let the idea of dividends generating more dividends mislead you. SCHD is not the ultimate ETF that can outperform market benchmark like VOO while delivering those sweet dividends at the same time. Let's be real, you can't have your cake and eat it too. If higher returns are your goal, you should look at ETFs that focus on growth. That said, SCHD has its own strength. It offers steady dividend income year after year and great resilience during economic downturns. So when it comes to the question which you should pick between SCHD and VOO, the real question you need to ask yourself is, what's your priority? Are you focusing on growth, or do you value passive income and strong risk control more? This requires different investment strategies. If you are optimistic about the economy and think the market will mostly trend upwards in the long term, VOO is a great option. It's designed for growth, which makes it particularly appealing if you are young and can handle a bit more risk. On the other hand, if you are feeling cautious about the economy's future or nearing retirement, SCHD might be the better fit. Its dividend provides regular cash flow, which can help cover daily expenses, while your core investment stays untouched and continues to grow at a decent rate over the long term. It typically holds up better during market crashes. You're less likely to lose your hard-earned money when the markets get shaky. Of course, nobody can predict the market. If you don't have a strong opinion about where the market is headed, investing in both VOO and SCHD is a great strategy too. This approach offers the best from both ETFs, steady dividend income paired with a blended return rate that falls somewhere between the two, no matter how the market behaves. It's a great deal, especially if you value balance and diversification in your portfolio. As for myself, I've been investing in VOO for the past couple of years. As I get closer to retirement, I may consider gradually shifting my VOO shares to SCHD because I'm still interested in the idea of living off dividend when retired. If you are thinking about investing in SCHD for the same purpose, let me share 3 things I will do before investing. First off, no matter if you aim to fully rely on dividends or mix it with income from other sources, you need a solid plan. If your goal is to live off dividends alone, you'll need to accumulate a lot of shares before retirement. Otherwise, you'll have to sell shares to cover your expenses, losing more future dividends, which is the opposite of the idea of living off dividend. That's why having a well-thought plan, starting early and sticking with it is so important. Next, when planning your retirement expenses, don't forget about inflation, which is the silent eraser of your buying power. $60,000 annual budget sounds very decent today, but what feels comfortable today might barely cover the basics in the future. If you are unsure how to calculate this, I got another video breaking down exactly how much you need to invest now to be a real millionaire in retirement. Check this out. And lastly, investing in a tax advantage account like Roth IRA if you can, because most people will need to pay capital gain tax on dividend you receive, which will hurt your overall return a lot over the course of 30 or 40 years. That's everything for today. Remember, this isn't financial advice, just my perspective shared for educational purposes. Feel free to leave your thoughts on VOO or SCHD below. I'd love to hear what you think. Don't forget to subscribe. I'll catch you next time.